All right. Recording is started, and for purposes of the recording, I'm Brian Wilson, joined by Henry Howard. Today is June 27th. And Henry and I will be kind of dividing, kind of doing a divide and conquer here today. And I thought to start with, perhaps we could start just by asking Henry a couple of questions. He had, I thought, a really good market desk note yesterday, brought up a couple of good points that perhaps we don't discuss very often in terms of position size and, perhaps thinking through risk management tools. And I'll share my screen for a second and show you what I'm talking about. So this was yesterday's note that Henry sent, and a couple of points that I wanted to ask Henry as we get going. He mentioned position sizing in terms of small, medium, large, larger, largest, and then bet the farm. And then he had a few conditions here in terms of good times to make money. So Henry, I guess in context of that, maybe let's start with a tough question. Bet the farm. What does that mean to you? Would betting the farm, would that be on a portion of your like tradable assets? Henry has two kids. I'm assuming that he wants them to go to college at some point.
Go to a good college, Brian.
Exactly. So what does that mean for you when you're making larger position sizes?
Yeah. So the caveat I didn't put in that note is that's obviously a distribution. The short tail is really small trades that I just don't, as a rule of thumb, I don't dabble, because dabbling is a lack of commitment. And this outside of, I think we're going a bit beyond I'll start by saying this. All of the trading I do is informed by edge data and individual sentiment and supply, short volume, and broad market and sector analysis. So all of that's informed, but the tail on the small sizing there, it just is a no. If it's like I could dabble in this, that tends to be a distraction and a takes away attention from things that I'm very interested in. And then the middle of the curve is 75% of my trading portfolio. I tend to not and then there's the rare case that I see something and when it's bet the farm, I tend to shorten my time horizon. Like I mentioned that yesterday, is that by bet the farm, I'm talking about 100% of my trading portfolio, and and not just in a 1-to-1 ratio, but into a more leveraged position.
But that's more of a short-term trade, very short-term trade.
Yeah, well, absolutely, and expectation for how it plays out is the expectation that it turns green. Like I said, it's got to turn green within the first 2 hours. It's a break-even stop, and you're just kind of baring your teeth and white knuckling. But again, that's a rare instance. The middle of the road tends to be that large sizing, just because you have to make money to make it worth it. So I hope that I'll let you ask another question. I have an example of what a medium is, but I'll let you ask another question, then we can move on to that.
No, perfect. For those who just joined the call, let me give you a clue what we're talking about. This was Henry's market desk note yesterday. What we're looking at, or what we're briefly discussing, is position sizing. We don't do it very often, or we don't have this discussion very often. So I thought it would be worth the time at the beginning of this discussion to kind of mention that. And it was a good thinking point for me as well, Henry. I don't necessarily have specifics like you do. You mentioned some very quantifiable steps here. I appreciate that. That's probably something that I need to get on paper a little bit more in terms of, I have it in my head, but what do those conditions actually look like for me? I will give you a clue in terms of when my position sizes get larger, and that's when we go below the green line. I always get much larger on my trades below the green line. It doesn't occur very often. If you look back during the course of the last year, when has sentiment gone below the green line? One, two, three, maybe four times, five times. Once again, it's a rare occurrence. So when it does occur, it's hard to do as well, because usually the sentiment has been dropping. Here's a great example. Usually that means that the market has been under pressure, and it's hard to really step up in a sizable manner when the market's been under pressure. But historically, the case has been very good returns under those conditions. So I'll just share that one point in terms of kind of some of my position sizes. It tends to get larger when we get below that demarcation there. And Henry, I'll turn it over to you. You mentioned that you had an example of like medium trade.
Yeah. So 2 weeks ago, I was in that AER trade. So AER, I'll go ahead and share my full window here. I think Brian, you mentioned it after me. But I think Tim mentioned it before me. So we were all climbing in on this trade. So here was AER, and I'm going back what I'm looking, so AER, I tend to look, as most of you know, I tend to look in big cap, and I tend to stay in the momentum portfolio most of the time. But I will watch, I'll keep my eye on the low volatility, especially when we're going into options expirations and there's higher risk. And in this case, we had AER that continued to have, stable demand, and we had this supply that was ticking down, and so it reached, I think
it's okay. You're not.
I got
it's just audio
at about 90 and a half. So it was right in here in which I entered this trade. But position sizing, it was a quarter of, I'll lever my trading portfolio. But this was a quarter of my portfolio.
I'm sorry, can you mute it?
Henry, can you
we don't
unmute yourself? Yeah. Henry, can you unmute yourself? I had to mute everybody for a second.
Okay, yeah. So, okay, so starting with position sizing, low volatility. We're going into expiration cycle. I'm not begging for risk, but I see AER and it's continuing to hang out in the low volatility portfolio. So that draws my attention to it. And to me, right in here, this is a great setup. And so I'm taking this as, man, it's right in this range. And I entered, I think it was I entered closer to, this was the 12th, because it was going into the weekend, and I was still okay at 90. And I was even, I think that Monday or that Friday, it went as low as 80, near 86 and a half. Now, if I had a bigger position on, I wouldn't have let it hang on that long. But knowing that AER had been in the low volatility, knowing the math, knowing that super low short volume, I can hold on to that and take that, I can stomach that, especially at a lower sizing. And even, the temptation to add to that position. Like, I think a lot of trading content is like, never add to a position, but maybe I'm an anomaly and then I go, I don't know, it's like, seems like a better price now. So even, when we talk about something being down its volatility, sometimes when it's down twice its volatility, I see that almost as a value play. And so, letting it play out, I actually, it was right at expiration. So knowing we were going into expirations, I actually allowed this to come back. I was just over break even. I didn't add to the position. I think I closed it out by the 18th. But to that point, the thing A, it was a smaller position sizing. B, I wanted to point out that here we continue to have short volume, even though short volume's rising, it's relatively low. And so those of you who are here who are new to Edge, 41% short volume, even though short volume's rising to 41%, it's still relatively low. And then, to my disappointment, I think it topped out at I think today or yesterday, it got to 97. So the point I'm trying to make is that the math is really solid. So I trust the Edge math. What I especially trust the Edge math when we're not going through big data releases or particular calendar events where we have big calendar risk. But this is a case where I'm, even though our rule of thumb is down 1% and you're going to cut it loose, I'm okay with holding through this. And the break even for me is just like, well, we still have some risk at expirations, but I wanted to point it out that, we still have relatively low short volume, really stable demand. And these are the types of things that we can apply the Edge math. We say math, but really it's the algorithm. It's the type of thing that we understand that these are high probable trades. And the fact that it's stuck around this, $90 level for a long time. So that was, an example to your point, Brian, of, I'm learning I'm learning something from this trade. B, I'm not putting my portfolio in a position where I'm going to lose so much that it's going to ruin my month. That's kind of that's the litmus test. Is I could I hate losing, I hate ruining a week, but I'm not interested anymore in ruining a month. So anyways, that's a smaller position sizing. And again, it was because it kept popping up in low volatility. So that's one. Do you have something to add, Brian? I'll toss it back to you before I keep talking.
Since you have your screen up, can you bring up INSM for a second and just show the setup there? Henry was mentioning a kind of medium-sized trade, and I actually went in on a medium-sized trade on this one yesterday. Now, part of the reason that I didn't supersize it, largest size it, whatever you want to call it, look at how long it's been at 10. It's been at 10 the whole month of June. It's had an incredible run, but with that type of run, it's a good setup. But the longer that it stays at 10, at some point you run risk of a little bit of rebalancing or a little bit of profit taking. So I was willing to take a medium size, position yesterday. I got limited out, but that was okay because it was a medium sized position. Once again, you're doing a little bit of discretionary work, especially ahead of big events. I won't totally cut off trading, this week, quarter end, rebalancing coming up, Russell rebalanced last week, options expirations. Tim will mention once in a while, well, should we just set out trading all the time? Well, no, you don't want to do that, but do recognize the risk in the background and take your sizes accordingly to what's out there. So.
Yeah, definitely pick your spots. And I almost INSM, despite it being in the portfolio, these names that are, I don't like being on the back end of these. This one's okay because we have falling short volume. But when we get into day 7, 8, 9, um, I avoid those, but I also look at this and I say, oh man, this is like ready for, this is ready to shoot out to over 70, and but knowing the risk, like the event risk that's coming up tomorrow, and the month end gives me some pause for going in heavier on it. So
Yeah.
That's a great point. Yeah, thanks for pointing this out, because I see when we see this, at least when I see this, it gives me a little bit of pause. So that's great to point out. Brian, do you want to start with a couple of your points, or do you want me to back up here?
Go ahead with your points, and then I'll kind of follow you.
Okay. So the other thing that I at the end of my note yesterday, I mentioned Apple, and I hope I'm not like beating the mega cap to death when I write desk notes. But it's such a significant portion of the market, and so I think it's hard to not understand. It's difficult to trade and not understand the impact that these larger names and large short volume can have on the broader market. And a lot of that is because passive models, it's bundling. So if Apple's move, if there's money flowing into Apple, that's actually, passive money is going to allocate not only into Apple, but all the S&P 500 components. So I'm going to pull up, I'm still sharing. I'm just double checking. You guys can all see this.
Yep.
This is a heat, just a really simple heat map. And it's funny, I can just like cut this down the middle. And what I see here is like TechCom and Amazon, as like that percentage of the market. And so thinking about composition and how passive models are allocating to tech, or they're allocating to communication services, and how these things move in tandem. I just want to bring that to the forefront. And, I occasionally use this just to see what different components are doing on a daily basis. But where I get my lead is from big tech. And so what I wanted to point out is all of these, I'm going to sort by market cap. So those of you who are new, we have a couple of new people in the call right now. So this is our big tech portfolio. Obviously have supply and demand. We have our volatility metric, and then I'll tend to sort this by market cap, if not demand. My point is, when I see AMD reaching 52%, when I see Apple reaching 52%, I start to see the potential that a name like Apple could, there's more risk. One, that excuse me, that the high supply and falling demand will actually remove money from passive, and that'll kind of be the end of this upward momentum that we've had. The alternative to that is at 54%, the moment this starts to get the moment that this short volume starts to get covered, if we do continue to have upward demand, like if demand bottoms at 5, and this continues to fall, I'll expect we have another leg higher. Does that make sense, Brian? I'm going to pause there.
Yep, sure does. Hey,
yeah.
Quick favor, Henry. Would you mind taking that heat map that you showed us and maybe just copy that and put it in the chat if anyone else is interested?
You bet. Yeah, I'll drop that right here for everybody once I get there. Okay. There you go. There's all little tools we can use, but they're all post, and the thing that Edge is helpful is it provides me a perspective outside, I think, of the daily metrics and the daily consumption of price. It's just too much. I compare price and volume and order flow. It all gets compared back to Edge data, partly because I know Edge data very well. So that's my point is, there's a risk in Apple that some of this, similar to what we saw in Nvidia, is demand was falling. So like if you weren't out of Nvidia yet, or you were thinking it was, like the move was going to continue, we know that because of allocation models, not because of decision makers, but because of allocation models, money has to outflow from Nvidia, and it's got more to do with the allocation models than it actually does with people making decisions that Nvidia is overpriced. That's not the conversation; it's the models that are driving that. So that's that's what I'll look. And then the last point I'll make, and then I'll stop blabbering, is I talked last week about the alignment of broad market sentiment and big tech. And so when I see when I'm down here in the big tech portfolio and I have low short volumes and I see big tech moving up, what do we see in the price of SPY? It's just a rocket ship, right? And these things are moving together. When I see that alignment, that's a larger sizing until we reach until we see that actually Apple and some of these names have higher higher short volume. This alignment tells me that there was still room to run. Now I think the event risk is more important than is more power is a more the event risk of month end is a more powerful force in the market than sentiment is at sort of 50% long short. So that's I'll stop there and then I'll toss it back to you, Brian, if you're ready to go.
Yeah, here, I'll go ahead and share my screen. Thanks, Henry. And I will ask you a question about big tech. I think I understand what you're saying, but I just want to confirm it for the audience here. So if we're looking at the big tech portfolio, and great point in terms of this rise in short volume and seeing the corresponding rise in the SPY. Now, to me, and correct me if I'm wrong, but as I'm watching demand go up and short volume go up at the same time, it communicates to me that market participants are having a difficult time finding natural sellers. So there's borrowing of shares to facilitate that trading. So in other words, for a period of time, higher demand trumps high short volumes. Is that the same takeaway that you're taking from that type of graph?
Yes, and I'll add that need to borrow shares for shorts actually contributes to the increase in price and the volatility. Mm-hmm. And that it's not until short volume levels out that we see the pullback in price. And that's what makes, to your point, that's what makes those sort of egregious moves in tech very difficult to short, because if at 540 it seemed expensive, at 545 it seems really expensive, but even if you shorted at 535, that's a tough that's a tough trade to stomach. And so to your point, like that short volume and that demand will actually push price higher, and then I think that's where we see those reversions or those pullbacks.
Mm-hmm. And if everyone takes a look at what was happening with big tech, I mean, it's a good learning lesson. To me, when you have higher short volumes, you can have that for a period of time. When the market really starts to come under pressure or starts to roll over a little bit is when demand starts to wane. So you get waning demand with higher short volumes. What's going to happen to price? Well, it's going to be difficult to continue to move forward. And you can see what's been happening in the broad market, just rolling over a little bit here during the last week. So yeah, thank you for that example. I appreciate that, Henry. I did want to talk for a moment just about our daily trading ideas. Hopefully, they're working well for you. Just a couple of principles on questions that I will sometimes receive, and just kind of walk through a couple of ways that I use the daily trading ideas. And of course, this is an open forum. If you have questions or if you have principles that are working for you, we'd love to hear them. So one idea that I'll mention here is, what does an entry point look like? That's one of the questions I've received recently. And what I'll do, and let's say I'm looking at this in the morning, looking at Pelotar, and I'm looking at a potential entry point. We know it's between, let's say, 23.50 and 24.50. It has about a dollar range. I will incorporate a pre-market look into my trading. So in other words, I'm looking for the best possible entry point, right? The better entry point that I have, the less likelihood that I'm going to get stopped out on my position. So let's say the broad market is weak. It looks like everything's going to be opening up lower. Well, I'm not going to be chasing these names at the beginning of the trading day. And what I generally do, and slightly different than Tim, same principle, but I basically just let the market open. I'll have the names that I want to watch in a portfolio. I'll be watching those names. I'll look at them about 15 to 20 minutes into the trading day. And let's say that Pelotar's down half of its volatility. Okay, fantastic. It's down at $24, halfway between it. It's a momentum name, great entry point. And one thing that I'm learning with the daily trading ideas is to not get too cute. And what I mean by getting cute is, let's say it's trading, it closed yesterday 24.10. Just for pretend, let's say it went down to 23.75. And I'm looking at it 15 minutes into the day. I'm like, oh, 23.75. Maybe I can get it at 23.50. And sometimes that game will work for you, and sometimes you can totally miss out on the trade. So what I'm learning to do, and to a degree, it incorporates what you're talking about, Henry, is I will just establish a position. Just get something on the board. Maybe it's my medium-sized trade. And then if it's at 23.75, I get a medium-sized trade on, and then maybe I add to it at 23.50. The point is, find something that you're comfortable with. If it's within your range, go ahead and get something out there if you really like the name, and you can, slowly add to it, during the course of the day. A couple different ways that I'm currently trading daily trading ideas. One is to look at those names once again, kind of 15, 20 minutes into the day, looking for those potential names. You can do it pre-market as well. Kind of accomplishes the same thing. I just for ease, I like to just look at it 15, 20 minutes into the day. One thing that I'm looking for is just an intraday bounce. If the name works perfectly, I get a bounce off of those lows. If I can close out the same day, oh man, that's a perfect trade. I don't have to carry it, over to the next day. Nothing's better than that. Another way that you can look at it is just end of the day activity. You look at your names end of day. Let's say something's down, most of its volatility. I'm just making this up, but Pelotar's down 5.3% here at the close. Like, oh wow, we know it's got it's in the momentum portfolio. Good divergence right now. Great setup. Our risk would be the fact that we're coming up on the conclusion of quarterly expirations tomorrow and the Russell rebalance. So, we keep in mind the context of the market, but a lot of times that end of day activity can work really well for you as well. If I'm looking at a lot of names, it gets a little trickier, right? Today, there were 39 names in the big low volatility portfolio and 36 in this one. So there was a lot of ideas. What I will do is I will start my sort by probability. and maybe I'll toss the names from 90% down to 100%, in my watch list, and I'll perhaps start with that. Another tip that Tim gave us a couple weeks ago was to look at the closing price, just sorted by closing price, and he likes to look at those lower priced stocks. A lot of times you'll get a little bit more bang for your buck. You can buy larger positions. And if you do get a little bit of movement, sometimes they'll move a little faster than some of those higher price names. So just a couple different ways that you can look at it. One is sorting by probability, and something that Tim does once in a while is actually sorting by that closing price. One thought here, and it kind of goes back to INSM, and I'll pull that up. I had showed that earlier. Sometimes if you get a good name, trying to figure out why that wasn't coming up. I must have typed it in wrong. There it is. Sometimes if you get a good name, it'll be difficult for it to go down half its volatility. And you can see how this one was just steadily moving higher over time. Some of these momentum names, they might go down a quarter of their volatility or what have you. So sometimes based on the name, you might have to adjust that entry price a little bit. But once again, you're looking for those dynamics where it's within that entry low and entry high, if that makes sense. I'll show you. Most of you guys that are on this call all the time, know that this is kind of the way that I treat it. But I'll have different watch lists. This is just one of them. EQH is a current holding. That's why it's at the top of the list. But I'll watch the top 15 components very closely during the course of the day. And it just gives me a clue as to what's happening in the market. And sometimes, even if some of these names aren't necessarily in the daily trading ideas, since they're very liquid, I will sometimes take advantage of those. I'll go out and buy a call, buy a put, if I see them down, more than intraday volatility or up more than intraday volatility. Now, that being said, I made a mistake yesterday. Amazon, it was up more than its intraday volatility. And I knew there was news out there, and I overthought the news. I'm like, oh, that shouldn't be affecting Amazon to this degree. I bought a put on it because it was greater than its intraday volatility. I lost a little bit of money. It was a medium-sized trade, but it was a good learning lesson for me because I bought and there was news out there. And that's something to be aware of. You can have a perfect setup, but if you see news that's out there, especially around earnings, that news related activity is going to really affect the trading. So just be aware of that. Most of you, we'll go here just for a second. MarketStructureEdge.com under resources. Most of you are familiar with our expirations calendar, but just as a reminder, you can find it here on the website, and you can tell this was expirations last week. The diamond is the Russell rebalance. You'll see that down here at the end. And both Tim, Henry, and myself try to be very careful in terms of looking at upcoming events, to keep you apprised. But you can look at this as well. 26th, 27th, 28th. What do we see for blue? Well, that's month-end portfolio balancing. That can be a time where you have window dressing, quantitative rebalancing, people trying to make their portfolios look as good as possible, as they send out their quarterly notes. And I'm talking about on the active investment side. Question for everybody. I'll stop sharing my screen. We showed you kind of that top 15 that I watch. Henry has that, heat map that he sent to everyone. Do you guys have any other good tools that you really like to look at every day that you kind of keep, at the top of your list? Henry, do you have anything other than your heat map kind of look?
No, I mean I have Edge.
Yeah.
And I have just what you showed us about uh expirations calendar. And
Right.
that tends to be um enough. I've found news feeds can tend to, like certain names, like the Amazon move, they'll move because of news, but it'll either show up in the Edge data that it's going to move, or I don't know how to find that until after, and I don't trade the news,
Mhm.
and I think it can be a bit of, at least for me, it can be a bit of an emotional trade more so than calculated. I know people that do that, but it's not my bent.
Mhm.
I'm a
Yeah.
purist, Brian. An edge
I get
purist.
Brian?
Steve, you have a question?
Yeah, I use pivot points.
Pivot points? Uh-huh.
Very reliable. When I see that when I'm using the trading ideas for low entry and I see it going in a downward motion, I might put a buy at the pivot point.
Okay. That's good. Yeah, part of the reason, just circling back to, why I watch the top 15 new names, why Henry's watching big tech is, that's approximately 50% of the market. So, when you're looking at 50% of the market, that's going to impact, of course, overall trading. Let's circle back. We're actually already coming up to the end of our time. It's kind of fun when you're having a good discussion and time flies by. Uh, what I wanted to show you was broad market sentiment and what we call, what's next. We're at a potential inflection point here. We came through options expirations here. Next will be this next green dot, which will signify month end and quarter end. Of course, we have the Russell rebalance that takes effect after the close tomorrow. And I'd mentioned in today's note, we really couldn't be any more neutral. You look at broad market sentiment, 5-1 for 4 consecutive days. Short volumes are low, thankfully, right here at about 48.5. Essentially, just a neutral setup coming into these big events. I won't take you through all of the different portfolios, but I could show you one after another, just a couple here. You can see that, well, that's Bitcoin. Sorry, that doesn't help. Communication services, right, at about neutral. Consumer discretionary, right, at about neutral. Consumer staples, right, at about neutral. The only component that is really above it right now is that big tech component, and that currently is at 6.6. So it's coming down a little bit, and I think the path ahead to me is dependent on what's going to happen with big tech going into a new quarter. Do we see the same? And let me enlarge this so you can see it a little bit better. Do we see the same type of enthusiasm that we saw that led to this rally, or does this sentiment fade continue? And really part of that is to be determined. We wish we could tell you, but we're data dependent for a reason, so we don't have to guess in terms of what's next. One thing that I will share from a broad market perspective is we're starting to see short volume really run in about 6 to 7 day increments. And what I mean by that, if you see a move lower, it will tend to run about 6 or 7 days, and then it'll move higher for a little while. Look at the period through here. Short volumes went up for about 6 or 7 days. They went down for about 6 or 7 days. That tends to be kind of the rhythm of the market. Central tendency, if this occurs, and if short volumes start to move higher in the new quarter, well, all things being equal, that would weigh on the market just a little bit. I don't know if that's going to occur or not, but it's just kind of a central tendency that you can see in the data over a period of time. Henry, anything for you on kind of that what's next look?
I mentioned Apple. that it's running hot. But if you look at if you look at Microsoft, it's like hope everybody I assume everybody owns some. But the cover, we were in this I mean, I feel like we've been in this we were in it a year ago, and I think we've been in it since about November of last year, where these demand cycles kind of just lift us hot to the next level, and then everybody goes, does anybody want to sell? And everybody we see 50% short volume, and then that gets covered, and that coverage actually moves us up to the next level. And until I feel like until we see something from a broader risk perspective, that will be the cycle. Is that there's there's a move that gets hedged, and then that short volume gets covered, and then there's a move that gets hedged, and that short volume gets covered.
Right.
That's kind of my expectation, and what we've seen over the last almost year and a half, outside of the interest rate changes, but all that's sort of event risk. And
Right.
to Pam's point in the chat about tariffs and taxes on tech, like I believe that the market will kind of take that in stride, and nobody's going to jump the gun on those projected risks until they actually happen, and then we can and then we can go short if we need to. But
Right.
from a data
I
perspective,
guess,
we're only
I guess the
getting
way
better short
to,
volume.
sorry, Henry, I'm interrupting you. I apologize.
No, that's from a data perspective. Like if demand kicks in again, like I don't see why we can't go up a little more. But
Yep. We are quite simply at an inflection point. We call it an inflection point for a reason, because strategies and tactics can change. You can be slanted one direction going into it. I remember a few months ago, man, we had a terrible setup going into an inflection point. Looked like the world was going to end. And then, you flip the calendar over to another month or another options expiration cycle, and all those strategies change. So just be aware that, whatever's happening in the market can change at inflection points. It's why we watch it. It's why we update you on a daily basis, in regards to what's happening. So I think we'll leave it at that. We've kind of run through our time today. Thank you for your questions, for the discussion. We always appreciate you guys jumping on, and we're always here, always available if you have any questions. So thanks for your time. We'll stop the recording and end it there for today.